Welcome back to Financial Level, the podcast where we break down complex financial topics and give you real, practical advice to make smarter money decisions. Today's topic is a big one. Should you buy a home with a mortgage or save up and pay in full? This is one of the most common and critical financial decisions people face, and we're going to break it all down today. And as always, I'm joined by my co-host, Michael, who's got some great audience questions lined up.
Hey John, glad to be here. This is such a hot topic right now, especially with interest rates fluctuating and housing prices rising. A lot of people are wondering, should I take out a mortgage and lock in a home now, or should I wait and save up to buy in cash? I've got a ton of questions from our listeners, so let's dive in. So, let's start with the basics. What are the main differences between buying a house with a mortgage versus paying in full with savings?
Great place to start. Let's break it down. Buying with a mortgage, you pay a down payment, typically 10 to 20% of the home's price, and the bank loans you the rest. You make monthly payments over 15 to 30 years, plus interest. Buying with savings, cash purchase. You save up and pay the full price up front. No monthly payments, no interest, and the house is fully yours from day one. Each option has pros and cons, and what's better depends on your financial situation, market conditions, and long-term goals.
Yeah, and that's where most people get stuck. They hear different advice and don't know what's best for them.
Exactly. And that's why we're going to look at the numbers, the risks, and the real-life implications of both choices.
All right, let's start with mortgages. A lot of people think, I'll just get a loan, pay it off over time, and it's no big deal. But how much do they actually end up paying?
This is where most people underestimate the cost of borrowing. Let's crunch some numbers. Say you're buying a $300,000 house with a 20% down payment, $60,000, and financing $240,000 at a 6.5% interest rate over 30 years. Your monthly mortgage payment, principal plus interest, would be around $1,518. Over 30 years, you'd end up paying $547,000 total, almost double the home's original price.
Whoa, so you're paying over $240,000 in interest alone?
Yep, that's why mortgages make banks a lot of money. And that's before we factor in property taxes, insurance, and maintenance.
Wow. So someone might think they're buying a $300,000 home, but they're really paying closer to $600,000 over time.
Exactly. That's why it's crucial to understand the true cost of a mortgage before committing.
Now let's flip it. What if someone waits and saves up to buy a house in cash?
Buying in cash eliminates all interest payments, which means you only pay the purchase price. No financing costs, no debt, no monthly payments. Here's an example. If you saved up $300,000 and bought the same house in full, you'd instantly own it outright. No mortgage equals no interest payments, no lender fees, and no financial stress during recessions. Plus, you'd save that $240,000 in interest we calculated earlier.
That's huge. But realistically, how many people can save that much money?
That's the challenge. Saving up to buy a house in cash takes discipline and time. For most people, it could take 10 to 20 years to reach that goal, depending on their income and savings rate.
So, if you wait and save, you might miss out on real estate appreciation?
Exactly. If housing prices rise 5% per year, that $300,000 house could cost $500,000 in a decade.
Okay, so we know mortgages are expensive, but are they always bad?
Not necessarily. Here are cases where a mortgage can be a smart move. You can get a low interest rate under 4%. At lower rates, the cost of borrowing is much less. You invest the difference wisely. If you take a mortgage but invest your extra cash in the stock market, earning 7 to 10% annually, you might come out ahead. You have stable income. If you have a high-earning, secure job, leveraging a mortgage can allow you to buy sooner.
So, in some cases, using a mortgage strategically can be better than waiting?
Yes, but only if you manage debt wisely.
All right, let's wrap up with some practical steps. If someone's trying to decide, what should they do?
Here's a roadmap. Step 1. Run the numbers. Use mortgage calculators to see total costs. Step 2. Check your savings. Can you afford a 20% down payment? Step 3. Consider your job stability. Can you handle 30 years of payments? Step 4. Compare mortgage terms. Avoid high-interest loans and risky adjustable-rate mortgages. ARMS. Step 5. Plan for maintenance and taxes. Homeownership has hidden costs.
And what are some red flags?
Watch out for zero down payment loans. You'll owe more than the home is worth. High interest rates, above 7%. Too much wasted on interest. Relying on future raises to afford payments. If your income doesn't grow, you're stuck.
John, this has been eye-opening. I think a lot of people will rethink their home buying strategy after this.
Absolutely. And we want to hear from you. Are you planning to buy a home soon? Do you think a mortgage or saving up is the better option? Drop a comment below. Don't forget to like, subscribe, and hit the notification bell for more financial insights. See you in the next episode of Financial Level.